good news for the economy can be bad news for the stock market and vice versa. They don't need to cut rates to impact the market as if they cut rates. They just say that the conditions might align to where they might cut rates, and then people can preempt that and front run it and make decisions as if the Fed is going to do this. It just gets silly, and that's not how we're supposed to run an economy. So really, it's going to lead to volatility, and it's going to lead to some instability as the market actually realizes, like, hey, we're not going to be able to sit in the back of the classroom and copy. We actually have to do our homework. Everybody, just dropping a quick note in here. This episode went long, as I typically do. Really diving into some macro topics here today. Hopefully it's digestible. But I hit the hour mark easily, and I was only halfway through my outline and the things I wanted to talk about. So this will be part 1 today, and then we'll pick up with part 2. All right, back to the episode. Alrighty, hey everybody, welcome back to Remnant Finance. We've got a solo episode today, continuing on our theme of the second half of this year so far. We're going to be talking about interest rates today. This is going to be an educational episode. This is going to be kind of a primer on interest rates and a lot of the news stories today. I've been thinking about adding at the beginning of the podcast, adding in a couple of high level bullet points of news stories in the macro environment that relate somehow to things that we're talking about daily with clients, and just in general how we frame our financial strategy. And so, incidentally, the stories that are topping the charts today as far as headlines that matter in the macroeconomic world are pretty much all about interest rates. And so I've done a few episodes in the past about interest rates. We've talked to Joe Wither about SOFR versus LIBOR, if you remember those conversations. I did a series called Know Your Enemy where I went kind of into the mechanics of central banking, used my Encyclopedia of Central Banking as a guidebook to effectively read through their playbook, because none of this is secret. We kind of view it as this grand scheme, but it's not hidden. This is how central banking works. This is how the macroeconomic environment works. So there are a few episodes that you can go back and reference. So some of this might be repeat, but I wanted to really drill down on some of the specifics around interest rates and the stories we're hearing right now. So when I searched for the top 3 news stories around the macroeconomic environment this year, it's about the 10-year rate, it's about the forward guidance, and it's about Japan. All 3 of those stories are heavily invested in interest rate narratives, right? And so that works out perfectly, because I was separately, I've been thinking about doing an interest rate episode, because I think it's just so important for us to become students of macroeconomics, even if it's not something that comes naturally to you. A lot of people if you're watching, on YouTube or listening to a financial podcast, you are obviously personally interested in optimizing your own financial strategy, however that looks for you. But you may not be as into macroeconomics as either I am or people that eat and breathe this stuff. And so as a passionate observer of this myself, I keep seeing the same stories over and over, and I keep getting the same questions from a lot of people. And so the 10-year right now, story number 1, the 10-year Treasury is the most important interest rate, I would argue. I think that's pretty much the consensus view as far as things that matter for us as consumers, right? And so what we're going to get to by the end of this is we're going to try to answer the question of the Fed can cut rates and your mortgage doesn't go down accordingly, even though that's what you would think would happen. And why is that? And I hope by the end of this, you'll be able to answer that. That 10-year Treasury is around 4.7% right now. That's the highest it's been all month. And this is what's strange. Last week, we got a weak jobs report for the month of July. Very weak, and it got weaker. Now, it's kind of backwards in the economic world. Like when you read about expectations and what's going to happen, good news for the economy can be bad news for the stock market and vice versa. And so when the jobs report comes in weak, meaning more layoffs, more unemployment, less hiring, the market actually celebrates. And by the market, I mean the stock market, because they say, oh, this is an indicator that the Fed might cut rates, and that's good for stocks, right? And so you kind of have this weird dichotomy here, where what should be good for people is bad for the market. And inversely, if jobs numbers come in high, big hiring, low unemployment, the market might see that as a reason that the Fed might cut rates and therefore react negatively, right? So we get a weak job number, it could theoretically pull the rates down the Fed comes to rescue and everybody's good, right? That's sort of the counterintuitive way that the market views employment data. So in this situation, in July, we got a very weak jobs report. The economy lost jobs. They revised the prior 2 months down because this is a backwards reporting metric. It's not a great metric, but it's really the best we have as far as gauging employment, because employers report them on somewhat their own timeline. There's the expectation of when they are supposed to report, but typically you'll get a jobs report and then a month or two later, more data comes in and it revises, right? And so that's normal. That's about the best they can do with jobs, I guess. And I particularly remember in the Biden administration, there was a lot of seemingly like scandalous revisions where it's like, wait a second, you said this was the jobs for June, but then 2 months later you revised it this enormous negative number kind of thing. Well, we had something similar to that where there was expecting moderate job growth, and we actually got pretty significant job losses as we're revising these prior months. But July's came in weak. This is the first month reporting backwards 1 month. That July's going to get revised again next month and revised again in the following month. But we got a weak jobs report, and the expectation is, okay, well, now the Fed can come rescue us, and then therefore yields will drop, right? But the 10-year didn't drop. It actually went up. So we've got other factors like oil, the inflation fear, the long end of the bond market, which I hope is a phrase you understand by the end of this. It doesn't take orders from the Fed. It actually more accurately, or it tries to more accurately interpret the real price of money and not what people say. What people say leads into the second item that was kind of top of the list in the macro news, and that is the Fed has stopped telling you what's next. So Kevin Warsh is the new chairman of the Fed. His policy is to kill forward guidance. So the Fed meets next month, and at this point, it's a coin flip. It was about 60% of a rate hike, the odds. Now it's around 45, 46% last I checked. So basically, it's a coin flip, 50-50. Are they going to raise rates next month or not? So I think at this point, lowering them is off the table. So it's either keep them the same or raise them. But what's happening right now compared to Powell, where Powell was the chattiest Fed president in history, everything that he basically, I mean, it's kind of been turning into since Greenspan, it's sort of turned into a media frenzy what the Fed does. And so I think for a long period of the Fed's history, there weren't these constant meetings and releases and these different Fed governors talking and Powell giving these speeches. And I think that in the last few Fed chairs, they've really increased the amount of visibility, which has naturally made people more dependent on the Fed. And that's where that forward guidance comes in. So the communications, they use that as a policy tool. If Powell says we're monitoring conditions, but we can see a situation where we might need to exercise, fiscal discipline or something like that. People are parsing that. Thousands of analysts are parsing exactly what he might mean. That trickles into actual expectations of people, and that kind of gets into George Soros's reflexivity theory, like what people think about the market can sometimes come to be. And in this case, that forward guidance is a tool in and of itself. They don't need to cut rates to impact the market as if they cut rates. They just say that the conditions might align to where they might cut rates, and then people kind of preempt that and front run it and make decisions as if the Fed is going to do this. And sometimes it does that, and sometimes it doesn't. Sometimes it gets the desired effect without actually having to make any kind of policy change. And so Warsh is trying to kill forward guidance. He straight up is saying that, and he basically said, like, we're not in the business of moving the markets just with our words by saying things, right? This policy tool is something that he wants to get out of the tool chest. And that kind of makes it the Wild West. So the normal Fed chair, like the Fed meetings, typically was 350 words, I think. And now it's close to 100. Like, he's really trimmed down the Fed statements. He's not giving the Fed analyzers, he's not giving the macro analysts, et cetera, much to work with at all. And in fact, he's saying, you guys need to look at the numbers and data yourself, and then we actually need to look at the long end of the market, i.e. the bond market, the buyers, and see what they're actually doing, rather than us trying to, move the dial here and try to steer the ship, ahead of time. It's like, we're going to make the decisions we're going to make as we think is necessary, but the market should be doing its own homework. And so putting that back on the market removes the influence of the Fed. And I kind of think it's a good thing, even though there's a lot of hand-wringing over it, and especially on the left. I mean, because he's Trump's Fed pick, every academic economist is just losing their mind at what he's doing to the credibility of the Fed. And that I think they're all like too pointless to even talk about those kind of people. But we're not supposed to have a central bank that just dominates, monetary policy just by breathing and writing a statement that can swing the markets. And so I think I'm in support of reducing the influence of the Fed. And I think that if there's any chance that we're ever going to actually get rid of a central bank, which I believe is zero, but people do want that. And if you want that, then you probably should be supportive of their dominance degrading a little bit. And so Warsh is saying the market got too dependent on the Fed holding its hand. So he wants the prices to be set by buyers and sellers actually meeting at a real price, i.e. market forces. Very reasonable, right? And so instead of everybody just trying to wait for the next hint, Jerome Powell wore a red tie this week, and so when he's worn a red tie and he said this many words on this topic and he's used this phrase, then historically that's indicated that they're going to raise a quarter point, whatever. It's like all that kind of stuff it just gets silly, and it's not supposed to be that's not how we're supposed to run an economy. So right now the market's the market is reacting with pretty violent swings because it's sort of like the governor's off here. And so, something like last week he said, last meeting he said that the Fed has no tolerance for inflation. The Dow dropped nearly 1,000 points just in one session, just on that. It wasn't even, and that right there is an example of forward guidance. Like that is sort of a statement where they sort of show their hand a little bit, what they're thinking, and we get actual market reactions based on that. Because then you think, all right, well, does this mean it's going to cost more to borrow because they're going to try to fight inflation here, or are they going to look at the employment data and make decisions based off that? So really, it's going to lead to volatility, and it's going to lead to some instability as the market actually realizes, like, hey, we're not going to be able to copy anymore. Sit in the back of the classroom and copy. We actually have to do our homework and figure out. We have to place our bets without getting a little bit of inside information. And so that certainly is going to change things. And there's a pretty loud reaction against it. So we'll see if it actually holds, if he's able to stick to that. But that ties back to kind of the first point I made there about the 10-year. The 10-year is not moving. And it's almost like despite the criticism that for the Fed's credibility, they need to continue with forward guidance. It's like, well, for the Fed's credibility, they just lowered rates the last time that they did lower rates, and the 10-year still went up. And so it's like, hey, we no longer have the impact we do. So there's already a disconnect here, and that's something we'll cover later. Again, we'll refresh on the SOFR versus LIBOR, which pretty much did a whole episode with Joe Withrow. But their influence is fading a little bit, which on net I think is a good thing. But what it's going to lead to in the short term, I don't see any reason why this volatility is not going to be amplified. So Warsh deferring to the bond market, telling us out loud the 10-year, which I'll make the case is the most important one throughout the rest of this episode. The 10-year matters more than what I say at a press conference. The dot plot, where they put these, they each put a dot where they anonymously they put a dot on a chart where they think rates will be. And it's like he just didn't even do a dot. It's like, this is just silly. Like this, we should not be making economic decisions based on a dot plot, which is I also agree with that. And then the third big headline story, we've got the 10-year, we've got Kevin Warsh and what he's doing and changing forward guidance, and then we've got Japan. So we're going to get into Japan in the meat of what we're going to talk about today. And interesting, it's good because I had, in writing my outline for this, in studying, Japan comes up over and over. And so it regularly does if you study the bond market, if you study Treasury auctions, like Japan is commonplace. But particularly right now, the time is perfect to talk about this because of what they're actively doing at the moment. So Japanese bonds pay basically nothing. We'll get into a little bit more of the history, but they've had their rates pinned all the way down to the floor. And so you don't make any money by owning Japanese bonds, right? And so that gets into the yen carry trade. We'll talk about that. But why does a bond in Tokyo matter to you? Right now, or for 30 years at this point, Japan is basically the largest buyer of American debt, right? They own the most of it, and they show up consistently at every auction, right? And so now, because the yen is getting so weak, they're having to kind of pull out all the stops to try to defend their currency. And what they're doing is they're letting their bonds roll off. We'll get into what rolling off means later on when we actually talk about kind of the waterfall of bonds, but they are not renewing their bonds. So they're letting bonds expire. They're collecting that principal back, which moves dollars away from us and gets them the actual dollars that they want at this time in order to shore up their currency. So they're in the news right now because they have decided to not roll their bonds. And then incidentally, the U.S. Treasury and Scott Bessent have decided to help them buy their currency in order to try to recover it, right? So you could go into a lot more detail on what they did. The 86 billion, I want to say, that was put into the currency, one of the largest currency moves ever, and we effectively sold euros to buy yen. So we didn't actually lose any treasuries in an effort to prevent, prop up Japan without bringing down our treasury market. But then it's through the special drawing rights. Like, you can really nerd out on this stuff. The point of it being in the headline is that the biggest buyer right now is walking away from our bonds, which means we have to offer more on the bonds, which escalates our issues here with our debt. So one story here with basically three different avenues, this interest rate story that's dominating the headlines right now, and it's exactly what we're going to talk about today. So I will switch gears here and go to my actual outline, and I've outlined. I want to kind of talk about what I'll call the food chain of bonds, right? And where the Fed matters, where it doesn't matter, and bringing it back. The reason for this outline was based on a conversation that people are always constantly asking me. Not that I have any special insight, but when about housing decisions, when we're talking it through financial strategy, it's like, oh, I want to buy a house. Should I wait? Should I buy now? Are rates coming back down? And the short answer is I don't think rates are coming back down anytime soon. I think we're pretty much going to be in this environment for a long, long time, if not higher, personally. But who knows? But the question is, like, when the Fed did last lower rates, mortgage rates did not move down with it. Mortgage rates are still up fairly high relative to what they've been for a long time. And so the question is why? Why are we so obsessed with what the Fed does? We're having these enormous conversations about the betting markets and the prediction markets, what the Fed's going to do. Are they going to hike rates? Are they going to keep them where they're at? And is inflation enough for them to hike rates, or is employment low enough for them to cut rates? All this conversation, at the end of the day, it doesn't move the mortgage, one single percent. And so where is that disconnect? And that disconnect comes from how downstream, or how far down the chain where we sit is from where the money starts. And so that's what I want to cover today. So it's going to be kind of a long one. I want to go through all of this, and I'm going to use my outline here as sort of a talking point. But we're going to focus on teaching here, and hopefully I can convey these ideas. The more you read about this stuff, and I actually truly enjoy reading about this, so it comes naturally. And so the more you read about this, the more stuff, just like anything, like the more your foundational knowledge is, the more you have a tendency to skip over things and explaining it. And that's not my goal today, is to kind of go back to basic building blocks, because most people don't have that weird obsession, and they actually have lives and stuff that they do, and stuff that's more exciting, I think, than macroeconomics. But I think you should still strive to learn and understand these headlines, because they do matter for you. So that's what we're going to try to do today. I'm hoping, I would love feedback on this. So if there's something that's not clear that you want to explain in a future episode, I can take a crack at that in the future. But hopefully this all comes across and it makes sense enough that you get a few takeaways. And I sometimes, listen to a ton of economic podcasts. I read a ton of economic blogs, newsletters, books, and sometimes I go in and I start a podcast episode or something, and I'm like, all right, I kind of know everything he's talking about already, but I always try to pull one nugget out. So even if some of this is over your head, or some of this is repetitive and stuff you already know, hopefully there's one nugget or two that you can pull out where you can actually say, all right, I definitely learned that. So if that's the case, if you learn one thing, then we'll call that mission complete. The first item today, the first bullet point I want to talk about, is there's not a single interest rate. there's a whole stack of them, and the Fed only touches the very top. We kind of picture one dial that the Fed turns, right? Everything moves together, right? And that's that expectation where the Fed cut rates, a couple cycles ago, and mortgage rates climbed, right? That throws a wrench in our expectation when we have these conversations. So it's not actually like that. It's not actually just turning down a dial and then mortgage, savings, car loans, everything goes down, right? So, all right. So what we actually have is kind of this food chain. At the top of the food chain, we have the Federal Reserve. Then we have the biggest banks. Then we have a couple dozen giant firms that nobody's heard of. We have blue chip corporations, and then we have at the bottom you and me, right? Between the Fed and us, there's a long line of people or of entities, institutions that are taking the rate given to them, adding some yield on top of it, and charging the next player down a little bit more and a little bit more until we see those rates. But it's not that dialing one rate by the Fed translates and flows all the way down the chain there. It just is not like that. So the Fed controls the top, the overnight, the right now money. The Fed is on the short end of the yield curve. The bond market, the buyers, the real market is on the long end. And so the Fed's just controlling that very top of the chain, right? So what we feel, you and I, is what the rate becomes as it travels down the chain. It gets marked up all the way down. So we're going to start at the top. We're going to be in the overnight short-term world that the Fed lives in and actually has influence in. Then we're going to talk about the middlemen. And then we're going to finally go to the long end, the bond market there. And that is what the Fed does not run, and that's where your mortgage lives. So we'll start where the money starts, and we'll flow all the way down to the things that impact you. Okay, so we just established point number one. It's not one dial that the Fed turns. It's many different rates, and the Fed controls the short-term ones with a few different tools. So what's on the news all the time is called the Fed funds rate. The Fed funds rate is banks lending to each other cash overnight. That's it. It's not something that you or I interact with if the Fed sets their target for the Fed funds range. It's not that, okay, the Fed said 3 to 3.5 to 3.75%. Typically, it's about a 0.25% range there. It's not like we can then say, okay, well, now my high yield savings is going to be X. Like we are not getting the Fed funds rate. That is for large banks lending to each other reserves overnight. Okay. Every bank has a bank. The bank's bank is the Fed. You and I go to our bank goes to the Fed. Each of these banks keeps a cash account there, and that is their reserves, right? We talk about fractional reserve banking, we'll get into that, but all a reserve really is the bank's checking account at the Fed. So the Fed makes each bank keep a minimum. Now, we'll caveat that, we'll get to this later, but technically that minimum is 0 right now. But we always talk about 10% of deposits, right? So in their Fed account, their cash, their reserves there, that is where they keep the reserves for their fractional reserves, right? 10% is what we're going to use for our examples here. But that has to be settled up effectively every single day. So in the course of doing business, money goes out the door. If a bunch of people withdraw, they have less cash on hand. All right, so that reserve requirement dictates how much they need to have in that account based on what they have in their bank right now. So if they have a bunch of deposits that come in during the day and they have larger balances on their books, they're going to have a higher reserve ratio, right? If you have to keep 10% of your total deposits in the Fed, in your account at the Fed, then as your total deposits climb, that amount that is 10% climbs. And so you're going to need to plus up your accounts to get to 10%. Other banks, if they have a big withdrawals, their total amount of deposits declines, therefore the 10% declines. Now they're sitting on a surplus in their Fed account. And so the Fed funds rate is basically these banks lending to each other overnight just to make sure they're all on that reserve, right? So that interbank lending is the Fed funds market. The rate on those is the Fed funds rate. All right, so we need to anchor here, because this is what we talk about when we're hearing these news stories of what the Fed's actually trying to do. That's a market rate. Banks are charging each other. That's not a number that the Fed types into the computer. That's an actual market number. So why do we even, it's like we keep getting removed from reality a few steps at a time. So we're not actually, you and I aren't actually interacting with the Fed funds rate. Our mortgage is not actually affected by the Fed's fund rate. What is affected by the Fed funds rate is banks lending to each other in order to overnight keep their reserves balanced within the requirements, right? But even then, the Fed's fund rate is not actually the rate that they're lending to each other. It's the target, and we're going to get into how they try to frame that, how they try to steer what the market actually does. but the market itself is going to be between two numbers, and two tools we'll talk about in a second, that actually sets what these are traded at between the banks overnight, right? So they're charging each other interest to slosh these reserves around and just keep everything level, because there's no reason to sit on any more reserves than you need to. And so why would you not make a little bit of a profit, send it out overnight so someone else is good, and then the next day it settles back out? Like, it's just continuous inflow and outflow of deposits into the banks from us, from consumers, retail, institution, and then the ups and downs of the requirements within their 10% reserve requirement in their account at the Fed. Does that make sense? The Fed is only interacting with what's called primary dealers. There's 24 of them. We're going to cover that as well. But these primary dealers are keeping reserves in their accounts at the Fed. Okay? Now, what is the Fed trying to do here? Why does the Fed even care? The Fed has a dual mandate from Congress: employment, price stability. So they're looking at inflation on the price stability side primarily. If inflation goes up, they're going to hike rates, make money more expensive, cools things down. If jobs go down, they're going to cut. They're going to make the money cheaper. Things are going to heat up. It's a constant balancing act there that they're trying to do. And of course, I know we have our thoughts on the Fed, but we're just going to take it all at the premise of what the mandate from Congress is, what their charter says, what they're trying to do, and just assume that they're trying to do a mission. Like we're keeping our thoughts on the Fed, and it's should it exist, should it not, should we in the Fed, should we audit the Fed? Yes to all of that, but right now we're just focusing on the operations as they run them, right? And so they're taking those two things, inflation and jobs, and trying to balance those and make sure that neither one gets too far out of proportion. And they believe that by setting monetary policy being setting these rates here, or these windows on the rates using the tools we're going to talk about, that allows the downstream effects to ripple out throughout the economy, and either increase hiring because money is now cheaper, people are investing more, et cetera, or slow down hiring, which is not really something not really a problem that they have, but more like slow down the price inflation by making it more expensive to borrow, and therefore people are not as incentivized to take large risks, and so there's a lot of like downstream effects that they're trying to implement when they change the rates in order to meet that dual mandate from Congress: keeping people employed, keeping prices stable. So what are they watching for when they're talking about inflation? They're looking at the CPI, but they don't really use CPI. They use what's called PCE, right? And that is CPI, but they strip out food and energy. I mean, if you really want to laugh, dive into the process of how they actually calculate inflation. It's no joke. Like, people going into a grocery store with a list of items that have been the same for a long time, writing down the prices, and it's like, you could just catalog, Amazon Whole Food prices and data point every single day or every single month, and for the same basket of goods. It's like this could be done much more efficiently, but they're still having people go in with clipboards and writing down these prices, and then they cut out food and energy because they say, well, these are required, and so these don't reflect accurately because people are going to pay any amount for them. It doesn't matter. But then they'll also take things like, if beef gets too expensive, they're going to people would naturally substitute pork and chicken, and so if beef gets too high, we're going to remove beef and we're going to count pork and chicken because they're cheaper. Those kind of moves. And so it's like you kind of have to laugh at like how they calculate inflation. There is a website called Trueflation, which I think is a lot more accurate, but it also has, it's all backwards looking, and it's not a perfect metric either from everything I've read about it. Somewhere in the middle is where reality probably is, but then this is what they're working with. So when you see PCE, that is the core, the CPI, but stripping out food and energy. That's what they're going to be going off of. As far as the employment, they're looking at the jobs report. They're looking at wages. We're not going to dive too much into that, but just in summary, just know that those two things, price stability and employment, are what they are trying to balance when they're setting this range for the rate. They have what's called the FOMC, the Federal Open Markets Committee. That is 12 people, 12 Fed governors. They meet 8 times a year. They vote, and they publish a dot plot. That's that anonymous dot where they think the rate should go. And then they put out their findings to the market, right? And this is the part, these meetings are the part that used to really move the market, and now are kind of like TBD on what's actually going to happen. But to summarize all of this, the Fed is not moving these rates by force. This forward guidance, this idea that they can speak what they want without ever actually lifting a finger, that is their their most powerful tool, and that is what's being eroded right now by the new chairman. All right, point number 3. Reserve requirements are now 0. So the tool and the ability that the Fed has changed. Okay, so what we used to have after 2008, the Fed did quantitative easing, right? We'll talk about the mechanics of that soon, but we're flooding the market with reserves, right? We're flooding the system with reserves. So the system of these banks are getting an obscene amount of money added to their balances by the Fed. That is where the Fed's actually printing. A lot of times when we talk about the Fed printing money out of thin air, it's not usually doing that. I mean, there's so many acronyms, there's so many different tools that they use now. But really, if they're not in a phase of QE, which they have been pretty frequently since 2008, but if they're not doing QE, they're not, quote, printing money out of thin air. QE is legitimately printing money out of thin air. It's just an accounting trick. And so that floods the system with reserves. And since the great financial crisis, that's what's been happening. So now reserves go from being something that's scarce to banks now drowning in them, right? There's no shortage of reserves. There's trillions of dollars. And so the other point is, the other part of this is, since COVID in March of 2020, there is no reserve requirement. It's gone. I mean, I assume it'll come back, but banks are legally required to hold nothing in reserve against your checking account. That 10% that we talk about in econ class, that we talk about on examples, you might hear when people are explaining what fractional reserve banking is on a podcast, they always talk about 10%. That actual requirement is 0. And so that means that what the Fed used to use, its old tool, was managing a scarce resource, right? A scarce quantity of reserves. That doesn't matter anymore because there's so many reserves. There's a whole ocean of reserves sloshing around. And so the question now is not how can we nudge these scarce reserves? It's really just setting our target right now and trying to guide the flow of this enormous ocean of money. So we've got 2 rates that are kind of the floor and the ceiling of what we're going to talk about here. And this gets into our point 4 as well. But the Fed funds rate is not an actual rate the fund sets. It's a market rate. Like I said, it's the real price that banks are charging each other overnight. But what the Fed announces when they make these what we're waiting for in September is the Fed going to hike or not. Well, what they would hike is not the rate. It's going to be a range. They're going to say, we want the range between, say, 4.25% and 4.5%. And then it has to use tools to sort of herd the market into that range that they want. And so they do that with an incentive structure effectively. And so how do they actually herd it? So they have on the floor side of it, they have the IORB. It's called the interest on reserve balances. This is like an actual number that the Fed sets. That is the interest rate that the Feds will pay banks to leave their cash parked at the Fed. And so we talk about, it's pretty shocking that there's no reserve requirement, but in reality, smaller banks are in the ballpark. Last I saw of around 8%, give or take a percent, and then larger banks are more in the, say, 13 plus or minus 1% is the last ranges I saw as far as of what they actually keep on hand at the Fed. The Fed pays them to keep their reserves there. Right. And so that is that IORB. That is the risk-free rate. So a bank, if they can earn 4% by keeping it at the Fed, they're not going to put that money somewhere else where it could make less. And so that becomes the new floor for anybody else to do business. Right. So that IORB is what is a number that the Fed actually does set. What they're going to quote when they do the press conference is the range that they're looking for. And then kind of behind the scenes is going to be that IORB, the interest on reserve balance. So if you can leave your money with the Fed at 4% and then lend it to another bank for more than 4, you can get arbitrage. Vice versa, below, if you could, you're not going to lend it to someone for less than 4 when you can make 4 at the Fed, right? So it's not 2 rival levers. It's the Fed steers with one tool, right? The range that they're going to give, and then the actual lever is that IORB. So an analogy is speedometer, right? So you have the actual number that's set by the market. So the market's actually reading what's trading day to day, but between these banks as they're moving these reserves, borrowing from each other, lending to each other overnight. That's the actual market rate. But the IORB, you could consider the gas pedal, which actually determines how much fuel we're putting into this. And i.e., in this case, it's sort of a loose analogy, but it's setting that floor. And so when they say the Fed hiked by 1/4, what actually happened is they press the gas pedal, they crank up IORB by 1/4%, And so now the floor is raised, and now the speedometer is going to follow that, because no one's going to leave money parked at 4% when now they raise it to 4.25. Smart money is always going to follow the highest yield. I'll say the highest, safest yield, right? And in this case, the big money is going to take this yield as a guarantee, and so they're not going to lend out for less than they could earn at the Fed, right? Okay, hopefully that makes sense. The IORB, the interest rate on reserve balances, is the floor, because that is the amount that the Fed will pay banks in interest to park their money at the Fed, and that's where their reserves sit, even though there's a 0% reserve requirement now as an emergency response to COVID, but conveniently has stayed since then. Last I looked, last week, it was still at 0%. Okay. So I talked about this range here, right? So the range, and let's say, typically it's about 0.25% is the range that they're going to give you when they do the press announcement. What the market is voting on is the actual range going to move. So if we're at, say, 3.25 to 3.5 was the last range, and they're going to raise by 0.25 point, they would say our range is 3.5 to 3.75. That's the target. That's the zone where they want the actual Fed funds rate, that actual market rate, to live in. So the FOMC is going to vote on that. They're going to announce. They're going to say, all right, we want 3.5 to 3.75. Those two endpoints are not. It's not like that. The IORB is the floor. The discount rate is the ceiling. We're going to talk about the discount rate next. But those two tools are kind of around the edges. They're the actual the limiting factors, but they're not the rates themselves. And I know this is kind of confusing, but I want to give more detail for the people that are really into this, and hopefully, if you're already lost or you just don't care, which is very reasonable, hopefully you get a couple nuggets out of it. So the bottom of that range, if you want to get technical, it's called the on-RRP range. That's the actual floor. That's where money markets, non-primary dealers, can park their money at the Fed. No one in the world is going to lend below that, right? On the top of that range, near the top, 3.65, let's say, the interest on reserve balances, that's what the bank is going to pay the primary dealers, those banks, to hold their reserves. So that's kind of like the magnet. No bank's going to lend below that. And then at the top, we have the discount rate. That's the emergency window ceiling. What the discount rate is sort of the upper threshold where banks, if they need to borrow from the Fed, they need to pay to borrow from the Fed. We've kind of flipped a switch here. Like, you have too much money, we'll pay you to sit on some of it. You keep some reserves with us, we'll pay you. Now you need money, we're going to lend to you, but you're going to pay us this interest rate. And so ideally, the goal is that this now the Fed lending to the bank and charging interest to the bank, that's going to be the upper end of that range, because the bank wouldn't pay someone else, another bank, 4.5% if they can get if they can pay the Fed 4, right? So it's sort of it sort of couches around the actual market rates there. So if we I've got more notes on how deep we can go, but I don't want to get too lost in the weeds. We have the actual market rate. We have the effective Fed funds rate, as they'll call it, right? The trading inside a band, usually just below the interest on reserve balances. I think that's about as much as it makes sense talking about here. So if you're listening closely, I said that on RRP rate, there is that bottom floor there. That's not the IORB. So the big banks all have accounts at the Feds, but most money market accounts, most funds, but a lot of asset managers, they don't have bank accounts at the Feds. They're not big enough for that. So the Fed basically built them in their own floor. That's the RRP, their reverse repo facility. That's where money markets, they can park their cash overnight at the Fed for a set rate. So it's basically like those two numbers. There's two different numbers. One for big banks, one for, I'll call it small banks, but it's really everybody else, every other institution. And then on the upper end of it there, the discount rate, when we're not paying you, the Fed's not paying you to park your cash. Instead, you need to borrow from the Fed, and you're going to pay the Fed an interest rate. Those three things there, the discount rate, the RRP rate, which is what the small guys pay, not us small guys, like the small big guys, and then the IORB that the big guys pay. Those three numbers are the levers it actually controls, and somewhere in there is where the effective funds rate settles. Hopefully that makes sense. But I just, for the sake of time, I need to move on, because I can already tell it's going to be well over an hour, and I am not capable of doing under an hour, so that's not unexpected, but I've got a lot more to cover here. Okay. Number 5, we've got the repo, and this is the actual real big market. This is the biggest market. It's not the federal funds, it's the repo market. And the repo market, you can think of a pawn shop that moves trillions of dollars a night. That's what's actually financing the entire government debt machine. So this repo is a repurchase agreement. You have bonds, you need cash tonight. You sell me a bond, I give you cash tonight, but you agree that tomorrow I'll buy that bond back from you and pay interest. That's, as the person lending the bond, I get a little bit of interest there, and you get the cash for the night that you need for the night, and it costs you a little bit of interest there. A simpler way I've explained it in the past is, say you've got a baseball card, but you need cash, and I need to pay my rent, but I've got this $1,000 baseball card. Say it's a Chipper Jones rookie card, one of the best players of all time. Got a Chipper Jones rookie card, $1,000, but I need $1,000 cash, and I know I'm going to get paid in a few weeks, but I need it this week to pay rent or whatever. So I'll say to you, hey, if you give me $1,000, I'm going to give you my Chipper Jones rookie card, which is worth $1,000 as collateral. And then in a month, when I get paid, I'm going to buy that back from you. I'm going to give you your $1,000 back plus $50. So effectively, the net to you is going to be, you're going to make $50 in a month. All you had to do is just part with your $1,000 for a month, but you had collateral. So it's like a secured loan here, because if I defaulted, if I didn't pay you back your 50, well, you're not fully out. You have my Chipper Jones rookie card, and I really want that back as a Braves fan, right? So that's what a repurchase agreement is. One party is going to lend money to another party in exchange for collateral. The party that gave the collateral up is going to send that money back plus interest and return the collateral. It's just a swap. It's a paperwork trail, right? So that is the Fed's fund market, but that's not the large one. That what we're talking about right now, the overnight borrowing, that's happening in the repo market for the most part. So the difference between the two is the collateral. The Fed's fund is unsecured. There's no collateral that changes hands. That's these large dealers, these primary dealers. We'll cover what those are later. These primary dealers are exchanging with each other without collateral, just basically doing accounting tricks, one paying interest to the other, but there's no actual collateral underneath it. It's because of the standing. It's like J.P. Morgan and Morgan Stanley are not going to like screw each other over. They're so large, they're so well known, they have so much to lose. It's effectively a handshake deal. But the repo is actually secured. If the lender, or if the borrower, the one who gets the cash in exchange for giving up the bond, defaults or disappears, then you as the lender get to keep that collateral, right? So we've got the Fed's fund is a small club. That's those primary dealers, which we'll talk about. But the repo is the big public market. That's banks, broker dealers, hedge funds, money market funds, anything with a bond that they can pawn as cash. And so that is where all the money is. And what they're actually trading at is called the SOFR. That's the secured overnight financing rate. It's secured because it's backed by that Treasury collateral, the opposite of the kind of the handshake deal in the federal funds. It's the same theme as what it replaced. Or sorry, the handshake deal at the Fed is sort of what the SOFR replaced. And so just a quick history lesson on this. And again, we talked about this with Joe at length, but their system used to be called LIBOR. And LIBOR was the banks betting. Basically, they would ask a panel of bankers each morning what they thought it would cost them to borrow. So it was a guess, right? And that's what set the rates. So, of course, it was being manipulated. It got caught in 2012. And so they got rid of that. So now LIBOR, which was the London interbank overnight rate based out of London, it really stripped the power, macroeconomic power from London, moved it to New York City, because now what is actually happening in the largest market in the world, these trillions of dollars sloshing around every night in the repo market, which again, those are the small big guys, right? Not the primary dealers, but everyone else who's trading money overnight with secured collateral. That is the repo market. That market rate there is actually looking at real data and seeing what numbers actually traded at. What did people have to offer as an interest rate in order to get the deal done? That's the SOFR. That's the secured overnight funding rate. So SOFR is the actual rate that the overnight repo market is trading at. That puts some clarity and some actual market dynamics onto the rate versus what we had before, which was LIBOR. Now on to point 6. We're going to talk about primary dealers. I've mentioned them a few times. We're going to talk about what they actually are, and we're going to talk about what the Fed's actually doing. So there's a couple dozen firms that sit between the government and everyone else. They are forced to buy Treasury debt at auction. They're the ones who actually interact with the Fed when the Fed prints, when that QE situation, quantitative easing, when the Fed's actually generating new money, they're doing that with these primary dealers. So there's 24 banks and trading firms that trade. They're authorized to trade directly with the Fed. A lot of the names, basically any bank you can name, that's a large bank. J.P. Morgan, Goldman Sachs, Bank of America, Wells Fargo, and there's a couple foreign ones as well. But that's a golden ticket for them, right? That effectively makes them too big to fail. But that comes at a price. The price is that primary dealers must bid at every single Treasury auction. They're that backstop there, the buyer of last resort for the nation's debt. And so when the Fed, quote, buys bonds and prints the money, is it really the Fed or is it the dealers buying? So we're talking about two different things here. We're talking about a QE environment and a non-QE environment. In a QE environment, it's the Fed. The decision of the Fed to take freshly made money and buy bonds from primary dealers that they buy at auction, that lands on the Fed's balance sheet. The QE, in a QE operation, the dealer isn't the buyer, it's the seller. The Fed buys from the dealer. So you might say, why is there even a dealer in the middle? If the goal is for the Treasury to buy bonds if the goal is for the Fed to buy bonds from the Treasury, why doesn't they just go directly to the Treasury? Why do they pay an interest charge to a primary dealer to act as a middleman? There's two reasons. The Fed only deals with authorized counterparty, i.e. those primary dealers. And the big one, the Fed isn't allowed to buy brand new bonds straight from the Treasury. There's literally a rule against it, so it doesn't look like we're nakedly funding the government with the Federal Reserve. In reality, we are nakedly funding the government with the Federal Reserve, i.e. we're creating new money to solve the deficit spending problem. That is QE, and that is when the fire hose goes on. That's what we've experienced a lot since 2008. That's what happened during the COVID hoax. And so that is, I mean, I don't know if it's just they think we're stupid, but I mean, I think they're kind of right in the sense of our economic understanding, but they're not allowed to buy directly from the Treasury because that looks like undue influence, or the idea is like it's supposed to be a backstop and all of the kind of the myths about the independence of the Fed, all of that stuff. They can't actually buy directly from the Treasury. So instead of being like a naked trade here, they just throw a little fig leaf on. The primary dealers buy the Treasuries because they have to. That's their obligation that comes with the golden ticket of being a primary dealer. They have to show up and scoop up the leftovers at the Treasury auctions, right? At market rates. It's not like they have to buy them at a fire sale, but they have to buy whatever's left over after the actual purchasers, after all the orders are met. If there's anything left over, these primary dealers have to come in and buy it. And then in a QE environment, the Fed will go in and buy those from the primary dealers. So in that sense, in the QE world, it really is just straight up the Fed is funding the Treasury, even though that's not what it's supposed to be. And this is kind of a side, like sort of a side tangent there on QE. And we always hear about like it's paper money, it's monopoly money, it's printed out of thin air. Well, not usually. Not usually when things are operating normally in a non-QE environment, but in a QE environment, there's no sugarcoating. It really is buying out of thin air. So when they buy the bonds from the primary dealers who are forced to buy them at auction and scoop up the leftovers from a Treasury auction, that money literally is keystrokes. They basically say, you guys buy it, and then we're going to credit your account with money that shows up on a liability for us. The bonds show up on our balance sheet, a credit shows up on your balance sheet, and now we've just created new money into the economy that starts with those primary dealers. That is what QE is, and that is why we say that the Fed prints money out of thin air, because during QE it literally does. It shouldn't do that. That program I don't think should exist, but that's where we are. And if we think about like Congress chartered the Federal Reserve, of course, there's the whole history of the creature from Jekyll Island, but there still is the Federal Reserve Act. Like it was an act of Congress that created the Federal Reserve. And so that means in QE, the government's literally just printing money to pay its own bills. Like they say it's not, but that's actually what's happening. Now, make a distinction here. I said scoop up the leftovers, right? Those primary dealers, those 24 banks and institutions, they have to buy up whatever is not bought by, or whatever is not sold by the Treasury, because the Treasury needs to fund the government. So how does the government get funded? It gets funded by collecting taxes and also by Treasury auctions, which is just a bond, right? Corporations have bonds as well. Well, whatever is left after the bond auction, they have actual buyers, other foreign central banks, investors, institutions around the world, institutions in America. People do show up to buy Treasury bills because it's the most safe collateral, right? It's a $50 trillion market, so it's very highly sought after. But every Treasury auction doesn't necessarily exhaust all of the ones that they need to sell, and so that's where those primary dealers come in, and they have to buy those bonds. But the difference is in comparing a QE environment versus a regular environment. In a QE environment, when other foreign central banks buy the Treasury bonds, they're purchasing with real dollars that actually exist, right? They earn those dollars by selling goods and services to Americans. They're selling them around the world. Everyone in the world transacts in dollars in some degree, as in Treasury bills, notes, and bonds that move around in the bond market. But dollars are kind of underpinning the global economy. And so there's actual dollars that exist currently that come back in to purchase treasuries when you have a real auction. But during a QE environment, there's no actual real dollars coming into the system. It's all new dollars, and that's where we really dilute. So when you see those charts of dollar creation in the last 5 years, that's why, because we've been doing so much QE. A lot of this is actually new money that's being flooded into the system. The Fed buys with money that invents, while those foreign buyers buy with money that actually exists. So one more thing about dealers, effectively these dealers are a pressure gauge. If real buyers show up strong at the auction, the foreign central banks, pension funds, you and me if we want, then that's great. The Treasury sells their bonds at auction, or their bills, notes, and bonds at auction, and they can get at a better price, because if everyone's bidding on it, if it's a highly bid up market, then they don't need to offer as much because people are willing to take it. If demand's weak, the dealers have to get stuck eating those leftovers. They call it a dealer takedown, and that pushes the costs up, because they're saying, we keep raising the rates and no one's buying. Eventually, we have to sell them to you, and so the cost to fund that debt goes up because they're selling these at a higher rate. So if you hear that, an indirect bid, that's a proxy for foreign demand, i.e. that's not us coming in and buying our own. That's not our primary dealers buying. That's foreign demand buying our debts at auction. All right, so does that all make sense when we've got what's happening when we have these auctions? Let's talk a little bit more about Treasury auctions, because that's a big part of what we're talking about here. That is the global economy in a nutshell. It's like, if you have to pick one thing that's the most important thing in the global economy, I think you'd have to say it's U.S. Treasury bills, bonds, notes, the three different types. And we'll get to what those three types are later. But when we thinking about these auctions, right? All of these pension funds, foreign investors, you and me, anybody who wants to invest is showing up to these auctions and buying them. You can go on like iGov, or like, I can't remember the site, but I bought bonds on there before. Like you could see the 10-year yield. You can buy a 30-year. You can buy these different duration bonds if the rates are appealing to you, right? And so for a lot of central banks, they are. And so there's actual purchasers, and then at the end of the day, this happens every week. At the end of this auction, the dealers are going to show up and bid, and they basically clear whatever yield the market demands. So here's how it actually works. So it's not what most people picture. The Treasury is going to announce the quantity, but not the price. They're going to say, we want to sell $40 billion of 10-year notes. The buyers are going to submit bids saying what yield they'll accept for how much. I want $1 billion and I'll pay up to 4.5%. I want $500 million and I'll pay up to 4.75%. Everyone's putting in their bids. They're kind of holding their cards back. They're not actually saying what the rates are right now. They're saying, we're selling an amount of this duration bond. So then they collect all of those offers, those bids, and then they're going to fill them for the lowest price up until all 40 billion are sold. So theoretically, if one person comes in and says, I'll take the whole lot of 40 billion at 3%, and everybody else is saying, I'll take a fraction of it for 4%, well, that 3% buyer is going to get all $40 billion worth of the bonds. So they're going to basically fill them in order, lowest to highest, until that yield on the very last dollar becomes the yield that everybody pays, right? Now, it's a little bit confusing, but it's like, we'll take all of your bids, but you're all going to get the very last one sold, that's the rate that you're all actually going to get. And so that's good for the buyers, but that's how that rate's set. So it's a demand that sets the yield. It's not them saying we're going to sell $40 billion worth of 10 years at 5%, 4%, whatever. So when you have strong demand, the buyers compete, they accept lower yields, and there's a lower clearing yield, that clearing yield being the number at the very end that they're all going to get. If you have weak demand, the Treasury has to climb further up these offers to unload the whole $40 billion. That's called that's the tail there. So a higher clearing yield is more expensive for the government. The more they have to go up these offers in order to find enough offers to take the debt, the more they're going to be charging themselves interest effectively, or the more interest they're going to be paying out. So the dealers have a backstop in that climb. So basically they'll come in and they'll say, we're going to mop up all the leftovers, but we're going to do it at the market clearing yield. It's not some lower number. Their obligation is to participate. It's not to take a loss. And so there's two, going back to the QE versus non-QE. In a QE world, they're effectively a pass-through entity only because the Fed can't buy them themselves. So it doesn't really matter to them what they pay for it because they're going to get made whole by the Fed, who's the ultimate purchaser anyways. But in a normal functioning market, they're going to bid at the yield they want, and so they're going to get whatever yield the market allows for, right? All right, so we're at the point of the auction where the last of it has been called effectively. All of the natural buyers lined up and put their bids in, and then whatever, let's say 30 billion is actually purchased on the market by real bids coming in, and there's 10 billion in bids that didn't come in, or there's 10 billion left that wasn't bid on. That's what the primary dealers are going to buy, and so the dealers are actually using their own money for this. Now they're going to earn a profit off of this. They're going to basically collect a fee for doing this because they have to participate in the auction and effectively scoop up the leftovers, but they're actually going to spend their own money on this. But then as soon as they get that, they're going to repo the bond out the same night. They're going to pawn it off to the money fund, and then they'll use that money that they borrowed to settle the auction. So it's kind of like they're doing it on credit almost. It's like, I'm going to buy that 10 billion, but before I give you the money, let me loan it out to the market downstream for me, and when they pay me, I will pay you, Treasury. And so now I've captured this spread in between. The whole thing, it's like you can see how with all these steps in the chain, and we've only covered a few of the first steps here. We're still at the very top of the chain here, talking about primary dealers before it gets anywhere near mortgages. And at this point, I'm gonna have to make this 2 episodes, and so I'm like halfway through my outline here of the things I wanted to talk about, and I feel like at this point I'm definitely past the point where most people are still interested. Hopefully can tie things back together on the next episode. So stick with me. We'll talk about just a quick summary here. We talked about it's not one dial, it's a whole food chain, right? So the Fed doesn't just twist a dial and adjust the entire chain of interest rates. There's 2 different kind of ends of the spectrum here. The short end, where the Fed lives and controls, and the long end where the actual market forces dominate. And the market forces that dominate the long end of the curve, that's where a lot of what impacts us is actually set by, right? So that's why we can have those stories like the Fed cuts rates and mortgage rates rise. The Fed funds rate is the rate that banks trade with each other overnight in their accounts at the Fed. So these are larger institutions. These are those primary dealers sloshing around funds to meet their reserve requirements, which typically we call 10%, but are now currently 0. But they still do keep reserves because they're getting at least that market floor. That's the IOBR. That was 0.3. That IOBR, the interest on bank reserves, that number, there's no reason that they would accept making anything less than that number. So that is one of the floors that the Fed can set by that rate. And that's how the effective federal funds rate, different from the target federal funds rate range, where that kind of comes into play. Also, we've got the discount rate. That's the rate that banks would have to pay the Fed to borrow from them on the top end of it. And that sets a higher limit of it because nobody would pay more to borrow than they have to at the Fed. And so by doing that, if it allows banks who are interested in maximizing their own bottom lines to have this floor and ceiling kind of general threshold, and in between there is where that effective federal funds rate comes in. we've got the repo market, and the repo market is the larger one. That's the actual party going on, while the Fed funds rate, those reserves sloshing around, is kind of a quiet, empty room. We've got the party happening with the actual repo market, and that's where everyone is piled in, and that's where money's actually moving trillions and trillions of dollars between broker dealers, hedge funds, money funds, the overnight market. For it's the same kind of mechanism of like, we're making this overnight deal and I'll pay you back tomorrow at interest. It's the same sort of mechanism, but it's actually collateralized, and it's actually the rates and what the market's actually doing take hold more in this secure repo market, where all the larger participants are doing it. Not the largest, not the primary dealers, but everyone else. I mean, primary dealers interact in the repo market as well, but we've got that repo market for everyone. We've got the Fed funds rate and the Fed funds reserves that the primary dealers, these 24 banks, have. And then we're talking about those primary dealers, who they are, what they do, what the mechanics of an auction is loosely. Again, I'm trying to balance keeping this like surface level, and also, not, I don't want you like drilling a hole into your eye socket from listening to this, but at the same time, I mean, it is important. So I'm trying to just kind of do a little quick look around into each little bucket here, and then move on without really diving in, because each of these could be 10 episodes in itself if you really want to dive in. And I would quickly get exhausted in my knowledge of this, because these things get so complicated. But hopefully you can find one nugget or two in here, and then we'll come back next week and we'll pick up the rest of my outline here. We got a few more things to talk about. We're going to talk about the prime rate. We're going to talk about your savings account, high yield savings. We're going to talk about the difference between T-bills, Treasury notes, Treasury bonds. We're going to talk about coupons. We're going to talk about the bond seesaw yield curve inversion, credit spreads, the debt waterfall, and Janet Yellen's $1 trillion unforced error. And then we're going to wrap it up with Japan and why Japan matters. And hopefully with that, we can answer the question as to why does the mortgage rate remain high, even if there's talk or actual implementation of a Fed's rate cut. Not always the case, but it has been lately. And then we'll bring IBC into this, because I think at the end of the day, our goal in IBC is to move up the chain and take control over more of these banking functions. And you can't really become your own banker without understanding the mechanics of banking. And even though they get complicated and they get dry, please stick with us and dive into any of these concepts that don't make sense to you, and let me know, give me feedback on this. So, all right, with that, we'll see you next week for part 2 of our interest rate breakdown. All right, cheers, y'all.